round of applause for Laura Foll, who's going to...
Cool.
Over
Great,
to you.
thanks very much. I'm aware that I stand between everyone and lunch, so I'm going to try and keep it succinct and leave lots of time for questions, keep it interactive. So let's talk about the UK. We don't need to read that, we'll go past that. Okay, valuation opportunities in UK equities. Now, I'm sure you've heard lots of my peers and equivalents talk about how UK equities are valued relative to the rest of the world, but let's just cover it again, just in case no one's seen it. So top right here, this is how UK equities, the price to earnings of UK equities, compares to the rest of the world going back to the mid-90s. And what you can see is that normally UK equities, so this sort of 0.85 line there, says UK equities normally trade at about a 15% discount to the rest of the world. We have slightly different types of companies here in the UK. We have banks, oil and gas, mining, cash generative businesses, but they do tend to trade at a slightly lower valuation. So we have 15% discount. We sort of trundle along, and then we get to mid-2016. No prizes for anyone for saying what happened in mid-2016. We get Brexit, and then we get a very steep derating event for the UK, and UK equities go to about a 35% discount to the rest of the world. And they've basically stayed there since then. And someone asked me the other day, but UK equities have had a good year, hasn't this valuation gap closed, haven't we missed it? Well, that sort of tiny blip up that you see at the end of the chart is this year. So we have closed a tiny bit of that valuation gap in the UK, but nowhere near going back to where we have historically been. The next question I often get asked is, well, the UK equity market is different. We have a different sectoral composition. We don't have much in tech. And that's completely factually correct. The tech weighting in the FTSE All-Share is low single digit. It's very small. So is it even relevant to look at the top chart? Well, that's why I've put in the bottom chart. And what the bottom chart says is, if you look at each sector, does that valuation discount still hold? Or is it just that the UK equity market has different types of companies? Well, what it shows is that there is a valuation discount in the UK across every single sector, to different degrees. Clearly you've got media there at one end, a 60% discount to the US, which looks pretty extreme. And then at the other end, you've got telecoms, where there's less of a discount. What is that, an 8% discount? Not so extreme. But just to give you an example, and obviously I don't do the US, I do the UK for the most part, but I wanted to give you some real world examples of this. We own Tesco, Sainsbury's, M&S in Law Debenture. Tesco trades on about 15 times earnings, roughly. And I was looking, okay, well, what does Walmart trade on? Walmart trades on 40 times earnings. Costco trades on 55 times earnings. And I would love someone to explain to me why Walmart trades on 40 times earnings. And I think I'd probably rather, I asked someone, by the way, at Henderson, why does Walmart trade on 40 times earnings? And they said, well, it's been a very good deliverer. It's delivered very good results. And I thought, well, so is Tesco, but I can buy Tesco on 15 times earning. So that's retail, and that's one of the most extreme examples. To give a more modest example, consumer staples there, 20% discount. The real world example of that would be if you take something like a P&G in the States, it trades on 22 times earnings. You can buy Unilever in the UK, both global companies. One happens to be listed here, one happens to be listed in the States. You can buy Unilever on 17.5 times, so that 20% discount. To be honest, I think both P&G and Unilever are probably quite dull. We don't own either of them. But again, it gives you that real-world example of the UK being at a valuation discount. And how is that reflected for us? Within Law Debenture, we are roughly 90% invested in UK equities because we see this as a valuation opportunity that will close in time or should close in time. So that's the kind of chart evidence. And again, I'm sure you've seen other UK fund managers making that argument. But what's the real world evidence that there is this UK valuation discount? I think it's takeovers. And these are takeovers that we've seen in Law Debenture this calendar year. Obviously, there have been others in the UK market as well, but these are the ones that we have felt within this particular portfolio. See Spectris here, an instrumentation company, well-managed, good company in its own niche way, being bid for by two competing private equity companies, KKR and Advent. so far at 100% premium to where the shares were trading on the market. 100% premium. That shows how inefficient, that shouldn't happen. The UK public market was clearly getting the valuation of that company totally wrong. You shouldn't see that type of takeover premium. And that's clearly an extreme example, but you see here in some of the smaller companies that we own, Renault, which is industrial chains, for the likes of Caterpillar, a private equity bid at a 50% premium. And even at that 50% premium, the shares are trading on roughly 11 times earnings, which goes to show just how extreme the valuation gap was to begin with. Something like IPF, which is the international version of Provident, it's a consumer lender, being bid for at a 25% premium, but still only 1 times NAV. So even with these premiums, Epwin, 30% premium, it's on 10 times earnings still. It goes to show how extreme the valuation gap has become in parts of the UK market. So there is chart evidence, but there's also real world evidence that the UK is too lowly valued. I wanted to spend some time covering this because I think me and my peers can spend a lot of time talking about valuation without necessarily explaining why it matters, why it's relevant. Why does PE, price to earnings, matter? Well, what we've got along the x-axis here is your starting PE and how you would have done 10 years later in real terms. So each one of these dots that you can see on the chart is a buying in year, starting in the 1970s. So each dot is a year, and it says, okay, well, if you buy in at X times earnings, how have you done 10 years later? So if you draw a line up from, say, 10, 11 times earnings, LawDeb, by the way, is on 12 times earnings. So say you draw a line up from 12 times earnings, what's the worst you would have done historically? You probably would have made, just from my eye judgment, 4% real return per year in the worst case scenario, and in the best case scenario, comfortably into the teens, real, i.e. adjusted for inflation, per annum, 10 years later. Now, that's not to say that you hadn't experienced some pain along the way. Now, remember, this is 10 years later. There would have been some pretty big drawdowns, undoubtedly, in this 10-year period. But if you were patient and you waited to the end of the 10 years, what it shows is if you buy in at a lower valuation, it historically stacks the odds in your favor of making a good return 10 years down the line. Whereas if you take where the US market is now, which when I pulled it up on my Bloomberg screen yesterday is about 22 times earnings, actually rather than 21 times. Firstly, there's not many times that the market's been that level, because there's not many dots if you look at it and you draw it from 22. But at the worst, you would have made 0 real return. The best, you probably would have made 2%, maybe 3, 4% there. So what it shows you is that history, always history, this isn't forward-looking, shows that valuation does matter. So if you're assuming that it doesn't, you're going against what history would tell you. So that's why the UK market is lowly valued, and that's why it matters. So hopefully I convinced some of you that the UK equity market is lowly valued, but sort of beneath that, where do I think the real opportunities are in the UK? And this chart is from Goldman's, and it says, okay, compared to these markets' 18-year history, what looks lowly valued and what looks highly valued? And I asked Goldman's, is there anything particularly special about 18 years? There's not. This was just the data that she could find. So what does it suggest looks expensive? I don't actually know anything about the Australian market, but it would suggest the Australian market looks pretty expensive. It would also suggest the US market looks quite expensive relative to its history. It would suggest the FTSE 100 index, the large cap index in the UK, looks roughly in line with where it normally trades. So it's at a discount to the rest of the world, but it's roughly in line. What looks more attractively valued within a UK sense is the FTSE small cap index, and particularly the FTSE 250 index of medium-sized companies in the UK. That would be right down there, along with some of the emerging markets in how it trades versus its history. So that is where we think the UK is an opportunity, but we think if you go beneath that, there's a particularly interesting opportunity in UK smaller and medium-sized companies. And on the right here, we've got how Law Debenture, which is the portfolio I co-manage, I'll come on to it in a minute. This is how it's positioned right now at the end of June. We've got roughly half in the FTSE 100, 10% overseas, and the rest of it spread across UK smaller companies. And that would be considerably higher than our benchmark, which is the FTSE All Share, and our peer group, which is AIC UK Equity Income. Wanted to also try and paint it in real world terms and talk about some stocks rather than keep it too general. But just bear in mind, we do have 150 holdings in Law Debenture. So this is not a shortlist high conviction portfolio. This is a long diversified list. But where are we adding? Coming back to that FTSE 250 opportunity, here are some of the medium-sized companies we're adding to. Johnson Service Group, textile rental for hotels, restaurants, gyms, that kind of thing. Zig Up, strange name, but it used to be called Ready Northgate, i.e. Northgate white vans, and Ibstock, biggest brick manufacturer in the UK. And in my simple way, what I like about these companies is that they are real products that I can see and feel, and I know won't be disintermediated by AI. I really enjoyed Alistair Unwin's talk earlier from Polar Cap Technology, but gosh, it made me slightly nervous about how fast things are changing. And actually, I think some of these real-world companies that I know, we will still need linen. We will still transport things in vans. We will still need to build houses in brick. And actually, I feel a lot better about some of these companies than I would if I was potentially owning a software company that's about to see its margins fall or get disintermediated. Where else are we adding to? Some of our peers, actually, so things like Aberdeen and Schroders, both now with their finance directors in charge of the companies and becoming more cost disciplined than I think they have been in a number of years. Something like Rathbones, again, new chief exec just come on board, Jonathan Sorrell, the son of WPP, Martin Sorrell, but brings a really new discipline to Rathbones, and we're buying into that type of company at a much lower rating than it's been in recent years. And finally, commercial property. Something like British Land is a pretty new position for Law Debenture. We're buying it at a 45% roughly discount to NAV, and over 6.5% dividend yield. And actually, we're through that period of hybrid working now. I work in one of the British Land offices in the city, very busy, putting our rents up, I think, actually. And where are we funding it? Because it's just as important to talk about where we're selling as where we're buying. And I know my inclination, or my peers' inclination, is to always talk about the shiny new thing that we're adding to the portfolio, but it's just as important to take profits and move on. And actually, I was interested to hear Stephen before me talk about defence. We've had defence exposure in this trust as well, but we are, in quite a few cases, taking profits from some of these names. So something like a Babcock, we have owned for the last, I think we bought it in 2021, so 4 years ago. And at that point, defence was very out of favour. And we would get questions about why we were owning defence. Something like Babcock was at that time trading on 10 times earnings. It was making a 4% margin. There were question marks about its management team. Where we stand today, it's trading on not 10 times earnings, but 20 times earnings. It's making not a 4% margin, but nearer 8. And remember, defence companies can't make infinite margins. They're serving the government. Those margins are pretty much capped. Babcock are the only people that can do things like submarine maintenance, submarine decommissioning. So they can't charge whatever they like for these contracts. And you've seen that rating already go from 10 times to 20 times. So we are taking quite a lot of profit from that area and rotating it into some of the opportunities I just spoke about. We've also had proceeds come in from some of these takeover offers. So something like Spectris, we sold in amidst the bidding war. Something like Dowless, which is the old GKN autos business, we sold when it was bought by American Axle. And then earlier this year, we need to know when we've got things wrong. And we sold the position in WPP, this is before its latest profit warning, because we could see that it was continually losing clients to Publicis. And sometimes, we do need to keep refreshing things and realize that actually we've got this wrong and we think this is more structural than it is cyclical. So we will occasionally move on from things like that. So that's UK equities. I think just to sort of bring all of that to a close, UK equities are at a valuation discount. There is a subset beneath that in UK smaller companies, medium and smaller companies, that I think are even more interesting. And thankfully, within the structure of this trust, which I'm going to talk about, we have the capacity to own that. So let's talk about Law Debenture. It's 1.3 billion. It sits within the AIC UK equity income sector, but it is a very unusual trust in terms of how it's structured. So bear with me while I try and explain it. There's two sides to it. Now, I only run or co-manage this side. the 80% that's an investment portfolio, which is mostly UK equities, as I was just talking about. And I work for Janus Henderson. I am not a Law Debenture employee. I work for Janus Henderson, which is a global fund management company. There is a completely separate 20% of the NAV, which is a professional services business. Now, again, I have nothing to do with it. We have the wonderful chief exec here in the audience, but I am not trying to run a professional services business at the same time as running the portfolio. That would be far too many hats. So this is completely separate. It's things like pension trustees, whistleblowing, corporate secretarial work, corporate trust work. It tends to grow mid to high single digit, but it sits within the same umbrella. And the reason, and I realize that when I say this to people, they look at me as if I'm slightly mad, as in, why is there an operating company and an investment portfolio within the same trust structure? So let me explain why it works, or why we think it works. And it works both ways. Okay. So in terms of running the investment portfolio, what is helpful about the IPS business, the professional services business, is even though it's 20% of the NAV, it's a third of the trust's overall income. So it effectively over-eggs on the income. And what that means is that when I come in on the 1st of January every year, I know that I've got roughly a third of the trust income in the bag without me doing anything from the investment portfolio. And what that means in reality is that I can own anything across the UK market that I think will generate a good total return. I don't have to limit myself to the relatively small subset of mostly larger companies that happen to pay a high dividend yield. So often when you pull up the top 10 or top 20, say, of UK income fact sheets, you will see the same companies on there over and over again. So you will see the GlaxoSmithKlines of the world, which, good and fine, tobacco, consumer staples. We can own those companies if we think they're a good total return, but we don't have to. So we can have a broader investment universe, and actually I'll show the performance in a couple of slides, but we can see it almost every year that quite a lot of the total return of this trust is coming from companies that don't actually pay any dividend at all, which is very, very unusual within an income trust framework to be able to do that. So it works that way. It helps the portfolio. And by the way, in years like COVID, when we saw very steep dividend cuts, that professional services business is much more resilient to that. And in those years, in the COVID years, the IPS business paid over 50% of the trust income rather than the third. That's the sort of average year. So it's very helpful from a portfolio perspective. But if Dennis, who's the CEO, was here instead of me, he'd make clear that actually it works for the other side of the business as well. Because if you're running the IPS business, the professional services business, you are part of a FTSE 250 listed business with a very big balance sheet behind it, and that helps you going out there and winning clients in a way that if you were a £200 million company without that listed side, it would maybe be a bit tougher. So actually there's a symbiotic relationship that works for both sides of the business. So it's unusual, and you probably wouldn't make it, if you were starting it again today and you were sort of pitching it to an investment banker, they would probably look at you like you were mad, but it works for both sides of the business. And it's worked from a performance perspective as well. So you can see here, you can see the trust return at the top and the FTSE All Share in the middle. It's outperformed this trust in terms of year to date, 1, 3, 5, 10, and also 25 years. 25 years isn't on here, but it's outperformed over 25 years as well. I'm not, by the way, in any way claiming credit for the 25-year performance. If James was here, who I work with, James has actually been involved for most of that time, so he can, but I'm certainly not taking credit for that. I'll touch on the 5-year performance in a sec, but if I just briefly drill into what's driving that year-to-date number, so 15% roughly versus 9% for the market. People like to be down about the UK economy, and you can probably roughly describe the UK economy as flatlining. But there are pockets of growth within the UK that have contributed to that 15% number. So what I mean by that is defence. Stephen before me described defence as that explosive growth opportunity. Well, we've had that as well. Babcock is the biggest relative contributor to performance calendar year to date for this trust. And we've also benefited from rising infrastructure spend in the UK. So another of the top performers this calendar year would be Kia. one of the big contractors. The UK government, for whatever anyone thinks about the UK government, they are committed to growing infrastructure spend, and that is benefiting the contractors, and then it's therefore benefited this trust. So we've had Kia, Babcock, and very unusually for an income trust, we've had Oxford Nanopore, which is one of the world leaders in genome sequencing. Here in the UK, we've had it for a long time. It's had its ups and its downs, but it's now growing really quite strongly and has taken people by surprise this year in terms of the growth rate that it's managed. So that's also driven that 15% performance year to date. And what I quite like about that is that those three things, we've got gene sequencing, infrastructure spending and defence, there's nothing in common with any of those three things. And actually, I find that really encouraging because what we don't want is for the performance to be driven by one thing. Because if it is that one thing will run out of steam. You want it to be driven by a diverse list of performers, and I'm encouraged by that this year. So that's what's driven the year-to-date performance, but let's look at the 5-year, because I think that's more important. And we're investing on a 5-year time horizon. The turnover of this trust is 20% a year, so we hold things for 5 years on average. So what's driven it? Number one, Rolls-Royce. Phenomenal turnaround story under the current chief exec. It's had that combination of self-help, definitely. They've taken costs out. They've enforced contracts in a way that they hadn't historically. It's had both self-help and also undoubtedly end markets. So the recovery in flying hours post-COVID was the first leg of the end market recovery, and then more recently, defence. It's another one, just like Babcock, where we have taken substantial profits in this name and are now actually slightly underweight our benchmark weighting in it. I always remember James saying, you buy this company when it was on 1x sales, and we were in size. It's now on 5x sales. So it is time to, and we have taken substantial profits. Something like M&S, we bought after Archie Norman, who's the chairman, came in. And this might sound slightly strange, but we bought M&S when, during COVID, they wrote an annual report where Archie Norman was absolutely brutal about M&S. He went through all of the things that they'd done wrong and what they had to, basically saying, similar to what the Rolls-Royce chief exec said, this is a burning platform. If we don't do something, this company is gone. And it was at that point that we thought, okay, they're finally going to address this and get a grip on this company. And the things that they had to do were actually comparatively simple. Now, I remember Archie saying to me, we have 30 pairs of men's black suit trousers. The consumer goes in there and is just completely bewildered. We need to reduce the SKUs down so far. It's total common sense. I'm sure it's a lot harder to do in real life, but it did sound like common sense to me. And that's what they've done. And actually, the results speak for themselves prior to the cyber attack, but I'm hoping that they can get the momentum back after that. Flutter, again, Stephen before me spoke about Flutter. I agree with everything he said. There is a huge amount of growth ahead for something like a Flutter. We have that here. We still hold it. And Babcock, which I've spoken about. So all of those things, Rolls-Royce, M&S, Flutter, Babcock, none of them paid a dividend for a big chunk of this 5-year period, but we were able to hold them in size because of the structure of Law Debenture. And then the flip side of the same coin is that we didn't have to hold the high dividend yield industries if we didn't feel that they were a good total return opportunity. So we haven't held Unilever, like I said right at the beginning, I think it's perfectly good and fine, but possibly a bit dull. Don't have to hold it. We haven't held Diageo, which has been a really poor performer until very recently. Astra has actually underperformed in recent years. We don't have to hold it if we don't think it's a good opportunity. And then finally, we have had the ability to go overseas. We've got about 10% overseas at the moment. Something like Applied Materials has been a good performer for this trust. But again, those overseas holdings don't tend to be particularly high dividend yield payers. So we've only been able to go there because of the structure of the trust. So to finish off, and then I'm going to take lots of questions, hopefully. This is a very unusual trust structure. It's a genuine privilege to run because we have flexibility that is unusual in this sector, and we need to make sure that we use it to its absolute maximum potential and find those opportunities in the UK, of which I think there are plenty, and use that structure to its full advantage. So I will finish there, and hopefully I will get some questions.
Okay. Any questions? Right here, Michael.
Hello. Thanks for your talk. I was wondering, obviously, there is a large valuation gap compared to the US, but the UK, I don't think ever has the same valuation as the US. So what gap do you think, what is achievable? A 10% difference, or maybe you could talk a bit about that?
It's a good question. So let me go back to this slide just so that we've got it up there. If you think the MSCI world, a lot of the MSCI world is the US, that will give you a fair proxy of where the UK traditionally trades. So that 15% discount that you can see for most of the time period, you could think of that as a rough discount to the US, which is roughly 20% from where we are now, if you catch my drift, so to go from a 35% discount to 15%. If you look at the sector-adjusted valuation discount, it's more like 20%. So both of those two things together would suggest 15 to 20% is roughly the range that you should be thinking about, because there is just being completely upfront, there is a different sectoral composition to the UK. So I agree with you that I'm not sitting here saying the UK market should go to 22 times. I think the UK market, could it go to mid-teens? Not a prediction, obviously, not forward-looking. But that's how I would think about the right type of range.
Hiya.
Hi.
Obviously, we've had a lot of discussion about pensions over the last couple of months. To what extent do you think that lack of real money bid in the UK versus the US is actually quite a significant driver of the discount?
Yeah, I think that's a really good question, and I think it is part of the valuation discount. So if you look at where the UK shareholder base has gone in recent decades, and this really is decades, not since Brexit, the domestic institutions, by which I mean the insurers and the pension funds, have been gradually selling down, and the rest of the world has been buying, and actually the majority of the UK equity market is now held overseas, which is unusual. And what Brexit did, people, including probably me just then, people blame a lot on Brexit. But what Brexit did in reality is expose the fragility that was already there in the UK market. So when Brexit happens, the overseas money that is now the majority of the holders of UK equities go, there's a higher political risk premium here, I'm off for a bit. And there wasn't the domestic institutional shareholder base to keep holding or to step in. So that derating, I don't think, would have been anywhere near as severe had you had a domestic sticky base that didn't do anything at that point. But it just exposed that fragility. So it's a good question. And do I think anything's going to happen about it imminently? Realistically, no. But what's interesting is that if you look at the flows year to date, where US investors are putting their money is increasingly in the UK. So while it's not the domestic institutions, they seem to be the same, overseas investors seem to actually be coming back to the UK, which I think is a really interesting trend and is what's helped to drive some actually pretty decent performance in UK equities year to date. So it's a frustrating thing for me that we don't have that domestic institutional base. But I think the evidence this year would suggest that actually UK equities can perform without them. And that, this year we've seen a UK equity return of roughly 13% for the market. This is more like high teens, both perfectly decent outcomes without that domestic base.
Okay, any more questions? Yes, one over here.
Thank you very much for your talk, Laura. Very interesting. My question is really about the sector that you represent, so investment trusts, and why it still feels like the poor relation given its discounts to net asset value. Very
good question. I think first thing I should say is this trust doesn't actually trade at a discount. It roughly trades at par and has done for quite a long time. Which is really encouraging, and we have actually been managing to issue shares on occasion over the last couple of years, which I find really encouraging. I guess the short answer is I don't know, because I think investment trusts are a really good proposition for people, particularly retail investors, and particularly those retail investors that want yield, because the yield often is very, very predictable of these trusts in a way that I run an open-ended fund as well, and the dividends from that would be much less predictable than the income here. So I think investment trusts are a very good proposition for people. I think maybe we as an industry haven't done ourselves too many favours in making ourselves easy to understand and explaining ourselves to people. It's something that we're trying to address with events like this, and it's really great actually to see so much engagement today. But I think, sometimes we don't make ourselves that easy to understand. And when you're buying something on a Hargreaves or whatever, and you have to tick a box saying this is a complex investment, it doesn't help. This isn't a particularly complex investment. It's just plain vanilla equities, basically. But I think, there's more to go in explaining investment trust to people. But I share your frustration that a lot do trade at a discount. Thankfully, this one doesn't.
We do still have time for another question, if there's any more out there. We can probably squeeze in two if there are a couple.
Thank you very much, Laura. That was a really good talk. Whilst we've got this slide up, I noticed that the discounts by sector vary widely. Do you have a view on any of these, on whether any of these sectors are just persistently worse than their international counterparts? So are British media companies, worse quality than overseas? And we're saying that the telecom sector actually outperforms in the UK? Or do you think that this is fairly random as a representation of the quality of UK sectors?
It's a good question. It's something I haven't really thought that much about. So this is off the cuff, bear with me. I think it's mostly random. It's in something like media, who knows what they're actually classifying as a media company in the UK versus the US. And things like real estate, they're not really globally comparable. That's why I picked up on retailers and consumer staples. I think we have some really well-run retailers in the UK. So that discount struck me as too much. And something like consumer staples, and you could say the same for pharma there, pharma at a 40% discount. Those pharma companies are completely global companies. It's basically just an accident of history where they happen to be listed. So the idea that UK pharma companies are at a 40% discount, that looks frankly silly to me. The same with consumer staples. But I wouldn't say, I don't know why telecoms is the one where we're at. That's slightly mystifying to me. So I would say it's mostly just random.
Thank you. And we have another question here from Leo.
Hello. Thanks again for the presentation. Could you go to the slide where it had the FTSE 250 and the FTSE 100 and so forth on that? So, yes. So the FTSE 250, as you say, is on apparently much lower valuation. First of all, is that excluding investment trusts, that measure there?
It will be, yeah.
Yes.
Because there effectively isn't a PE on an investment trust, if you know what I mean.
Okay, and do you think that's due to the size of the companies or due to the sectors they're in?
I think it's due to their domestic weighting. So the FTSE 100, roughly, is about 70% overseas in terms of its breakdown, whereas the FTSE 250 is more like 50-50, domestic and international. And what you saw, just to skip back a slide, this Brexit derating period hit the domestic companies far, far more than the Unilevers of the world. So the reason the FTSE 250 is trading lower is because there's an inherent skepticism about the UK economy as a whole, which is much more, the Zig-Ups of the world, the Johnson Service Group, they are domestic businesses. I think they're very well managed, lowly valued, market-leading businesses, all of that, but they are domestic. And there is still this question mark about, can you grow in a roughly flatlining UK economy? Now, I think they can, but that's why the FTSE 250 is there and the FTSE 100 is here.
And your weighting implies you think that's not fully justified, that because you're overweight FTSE 250.
Yeah, exactly.
Is there a limit to how much overweight you can be without diverging too much from the all share?
Yeah, I think that's a good question. I don't think we would go materially higher than what we are now in small and medium-sized companies. We are significantly away from where the benchmark is already, as you say, and we've also got to be mindful of liquidity. This is a 1.2 billion equity portfolio, and we don't want to get into positions that we couldn't trade in and out of. So I wouldn't expect us to go materially higher than we are right now.
Okay, any final questions? We're getting close to lunchtime now. Okay, last one.
I'm just interested to see. So you mentioned recent year, some more foreign investor come back to the UK market, right? But then isn't it like for most of the company in FTSE 100 is also a global company?
Yeah.
So can you explain a bit more like the dynamic?
Yes, you're right. So most of the FTSE 100 are very much global businesses. What even smaller companies are getting better at doing is taking themselves and doing roadshows in the States. So even if you pull up, so what I mean by that is even if you pull up the share register of quite a small company, say a FTSE 250 company, and look who the biggest holders are, actually a lot of the time it's not UK long, my equivalents at other Schroders or whatever, it's US holders. So I sometimes get incoming for some of our medium-sized industrial companies, from some US college endowment or something that wants to learn about senior. And I'm always sort of like, oh, you want to know about senior? That's great. I'll talk to you about that. So these companies are getting better at taking themselves internationally and building up a slightly different shareholder register.
Okay, I think that's it for the questions. So if we could just give Laura a thank you, round of applause.